Same channel.
Welcome to DeFi Crypto and Airdrops, DeFi Masterclass edition with my guests, as always, David and Jake. How's it going, gentlemen?
It's going good.
Well,
Yeah, I just got off a call with a client, so my apologies for being a couple minutes late.
No, absolutely. No, it's you're conducting business. We definitely appreciate you guys making time always to come and share your extensive knowledge as far as DeFi. But let me go ahead and jump into here. I want to make sure that we everyone knows where to find us. So those that don't know, we are actually only streaming on, as far as YouTube, we are only streaming on this account. And you'll know you're on the right account if one, if you're in the chat, and two, if you see the owl, the DeFi Wize newsletter logo. So also, you can see that Jeff, the blockchain report, his airdrop channels down here, Drew over at Blockchain Basement, David's DeFi University, his YouTube channel, Jake's YouTube channel, and Gina's. She's a new addition to our family, and she's starting to stream over on Arena, and just got onto YouTube. So, and then also you can find us on the Arena. We're streaming live there as well. Great platform on Avalanche, great community over there, and I'm loving the functionality to where people can show their appreciation. They can tip, they can buy your ticket, things like that. So that definitely helps out the channel. Over here we got Metrix Finance. This is Jake's portfolio tracking tool and simulation tool. And after the show, Jake, I want to show you a member of our community actually gave some really good input for Metrix.
I'm so excited to show you guys what we've been working on. I got an update for you today if we want to share it.
So. No, absolutely. Absolutely. I'm going to have David, he prepared some info on Canton. He did a deep dive on it. So I want to make sure that we share that as well.
Oh, yeah, 100%.
DeFi University. This is DeFiUniversity.xyz. This is David's free DeFi course, and it's all very it's very comprehensive, very well organized. Oh shit, I was already logged in. Why the hell did it log me out? Oh, here we go. So yeah, it has all the different modules. It has quizzes, a check on learning. It has, very, very, very good course. So I highly suggest that you take advantage of this. A lot of people are charging thousands of dollars to teach DeFi. The only part, yeah,
I charge $18,000, guys.
Well,
no,
you know,
we don't
what?
just teach; we consult. So that's what we do.
but you're giving your actual time. I mean, this is David put a lot of time into putting this together.
This is great,
but
David.
for the most part, people are on their own to go through it. Whereas with yours, you're like holding people's hand, and you're giving that one-on-one attention. So
yeah,
you get what you pay for.
Of course.
There is a paid portion of this. David does 2 hour-long video calls each day with him and the community. So it's an opportunity to get that mentorship and stuff, but it's only $97 a month. So great.
Worth it.
What's up?
Worth it.
Yes,
yeah,
absolutely.
Worth it. Sign up for DeFi.
Yeah.
Like what I want to go ahead and say is like, David was part of one of the large companies in the space that offers like he led the entire education system at one of the large companies in the space, right? And they charge a lot of money to get access to that. David now works for himself. David does great things, and obviously there's much lower barrier to entry. So you're getting access to somebody that literally ran one of the largest companies in the space. So it's like a no-brainer to do that, for that level of entry. You don't have to base it on like whatever you call it, size or anything, because the credentials are there. So
yeah, I mean, dude, I built that from 0 to $4 million in 18 months.
Yeah.
Crazy. But regarding that, I want to show you guys a little bit about what we've been doing at Metrix. So I'm going to share my screen and just, this is what we're building at Metrix. And I want to hear everything that you have to say, Myke, and even you, David. But we're basically building an AI system directly in Metrix where it can tie in with our API. You could say, find me 10 liquidity pools that do X, Y, Z. Find me this, find me that. Simulate this, simulate that. This is part of what we're being built, and you already know Mr. Lamborghini is going to do what he does best and copy it. But that's okay, because at the end of the day, you can't replicate quality when you don't have it on your team. But with that being said, we're trying to build a dashboard where you can track literally everything, like in your entire portfolio. So think about this like a DeBank and Jupyter aggregator. You could see your Solana portfolio, your EVM portfolio. And yes, this is great data to see, but how can you take this data and see more into it? So that's where we link with what we already have built, which is our tracking system, where you can track in-depth the performance of like profit loss and everything like that. One of the things that we're doing is we're optimizing our servers and stuff so everything loads faster. But we're also treating things like strategies. So like, as many of you probably know, David, you know this, like you run a liquidity strategy and then you're borrowing against your liquidity strategy. Or you run a lending strategy, you borrow against your capital and then you use that for a liquidity strategy. Or you run a short in conjunction with your liquidity strategy. That now becomes a strategy. That is no longer just a position. That is 2, 3 positions that can be tracked as a strategy, which is what we're putting a focus on in Metrix Finance before. And then in addition to that, we want to give more of a terminal feel. So, guys, that there's Poolfish, which is actually where we came from. We forked Poolfish when it was Uniswap Fish. This is a public tool, by the way. And the source code is out there because it was funded by the Uniswap Foundation. Now, Poolfish is super outdated. Great tool, very simple, but that's the extent of it. Super outdated, hasn't been updated in many years. They did a great job at the beginning. They just have not updated it. Now, in addition to that, you have DeFi Buddy, which is a fork of Poolfish. And they have like some of the other stuff too. You also have Metrix Finance, which our tool started as a fork of Poolfish. We built it out, custom coded, and built like a really, really good simulator. But part of what we want to do is we want to give more of a terminal feel. So this is me showing you the behind the scenes. Like we want you to feel like you're on a DEX, right? But a terminal. So think about Orca, where you can go over here and you can go to pools and you can select one of these. And now you're in this terminal for providing liquidity for Solana USDC. But what if instead of providing liquidity, you were simulating? What if you were mapping out your strategy on the trading view chart? You were simulating over here. You were looking at liquidity distribution, setting your ranges, looking at your estimated fees, choosing what time period. And then from there, you were back testing over a period of time. What if I invested 2 weeks ago? What if I invested 4 weeks ago? What happens if ETH goes to this price? And then I rebalance after that, and then it goes to this price. That's what we're building at Metrix, a true terminal feel for your liquidity strategies. So I'm excited to share that. That's what we have so far. Again, we're finishing up some of these mock-ups. Our dev team has already started working on implementing this directly in app. So again, these are mock-ups, but they're starting to make their way in the app, and we're hoping to wrap this up into February. So yeah.
Oh, nice.
Jake, I want to share something with you. Yes. I think you're probably the guy to be able to build this. And here, Myke, let me go ahead and just share my screen real quick. I want to share a piece of research. Over the last couple of months, Jake, I've been creating a lot of in-depth research and presenting it to everyone within DeFi. And what I've learned about liquidity provision is that you're essentially underwriting volatility. You are selling volatility when you provide liquidity. And so you're basically trading an options contract. You are short put. Now, here's the challenge. the only way you're structurally profitable as a liquidity provider is if the implied volatility in the pool is greater than the realized volatility for those same assets external to the pool. The difference between the implied vol and the realized vol, that's called your variance risk premium. And so, unfortunately, I think that for the vast majority of pools, if not just about all of them, outside of like maybe some stablecoin pools, there is no premium. You're not structurally profitable providing liquidity. But the challenge for me, Jake, is that I don't have a reliable window into variance risk premium because, number one, I'm not a mathematician. And so I'm relying on this guy, Guillaume Lambert. He's, on Medium. He's published a bunch of articles.
He's great.
Yeah, really, really good. But whenever I calculate this, Jake, for Uniswap V3 pools, like I built a little tool that calculates this, it tells me that the sigma IV in the pools is always lower than the realized vol external to the pools, which means that structurally, if you're trying to sell variance, if you need positive variance and it's always negative, then structurally you're likely not going to be profitable as an LP, especially when you think about your divergence. So this is something I just wanted to share with you. I don't know if you could do something with this, build it in or anything like that, but
I want to see what we could do because I mean there's a what do you call it? Like, again, there's a lot of tools out there. The one advantage that we have compared to all these tools is we're a business. Crystal, they are a business too, but they are a business that has to rely on charging fees to users that use their platform, not a subscription model. Us, we charge a flat fee and that covers everything, right? We charge $50 a month or $100 a month. You want to pay yearly, you'll get a discount. But the beauty of a model like that, David and Myke, is that means that we want to get you to stay. And if there's a little thing or something that we can add that improves the user experience, right? That's what we focus on because we have two types of ways to grow. Number one, we got to get people on the tool. And then once we get them on the tool, we got to get them to stay. So all this stuff falls under that. We're not focused on trying to extract the most money from you because you pay us one fee per month. Simple as that, and we can do all this stuff under that fee. So that's the structure that I like against us compared to others. In other companies, like, again, DeFi Buddy, it's free, but you're also going to be quite limited with what you can eventually do there before you end up behind a paywall. Just like ours, like with the free section we have. But also the other thing is, like, again, there's server cost associated with this. We've run analysis on all these companies and what their server cost is. It's tens of thousands of dollars for some of these companies, basically. For us, even, we're spending, upwards near $5K a month in server cost. The good thing about our model is we can actually sustain ourselves and we can actually build stuff and we can actually do cool things because we have that subscription revenue compared to other companies. So, yeah.
That's
so
right,
David, you said that you put together some info that you were going to do a little bit of deep diving on Canton. What were you able to put together?
I sure did. So here, let me, I'm going to go ahead and share my screen one more time and we can run through this research. All right. So let me just walk you through the process that I follow here. So you guys, I have been able to accelerate the pace at which I create research like this because of Gemini 3. So if you are very, very good at prompting Gemini 3 and creating great deep research prompts, dude, you can learn about any topic in the world. And so as I've been creating research and learning about Connexus and Canton, it's become clear that there is definitely a possibility that these two chains, these are JP Morgan chains, that these could act like a siphon, siphoning high quality TVL out of public DeFi chains like Ethereum mainnet. And so let me just go ahead and, I've got a couple of resources here, Myke. I've got a slide deck. I've got a piece of video content. And we could just run through the slide deck or the video content, whatever you want to do here. But the bottom line here is that the regulation, so the Genius Act, prohibits stablecoin issuers from paying yield to holders of their tokens. And although that's great for a bank or a business like Circle or Tether, because hey, think about it, they print money. They are not allowed by law to pay yield to holders of USDC or USDT, but they have to buy treasuries, and those treasuries or bills or whatever, or cash equivalents that they hold, pay some type of yield. And so they're just a cash machine. They just earn all that yield. But if you are an institutional investor and you are mandated to take the least amount of risk and earn the greatest yield possible for your clients, well, then if you're holding USDC or USDT, how do you earn yield on that? You probably, if you're going to take the least amount of risk, you're probably going to go to Aave Horizon and supply that USDC or USDT as collateral. You're taking on smart contract risk when you do that. You're taking on protocol risk when you do that. And you might be able to earn something like 3.5%, something like that. Now, compare that with you don't really want to compare it with the deposit tokens. If you were thinking about it from the perspective of an institutional investor, what the institutional investor wants is, if I just I'm looking for a specific slide here. And this slide is all about the repo, how you can use, as an institutional investor, you can use your capital on Canton through Connexus in repo markets. So if you are mandated, if you're a fiduciary and you've got to take as little risk and earn as much yield as possible, and you've got a massive amount of high quality TVL, and legally Tether and Circle can't pay you any yield, but you have to seek yield, well, you would definitely migrate your capital from Aave, from a public chain, to the walled garden of Canton. And you would do that because you can use that capital on Canton in a repo pool and earn a relatively risk-free rate of return. And you can manage all of your capital through JP Morgan's interface here. So this is called the mullet, right? So you've got TradFi in the front, business in the front, and DeFi in the back, party in the back. So this is it's called mullet banking. And this was coined by some guy over at JP Morgan. But I think that this is definitely a legitimate risk, man, because, like, if you've got a lot of money, let's say $1 billion, and, you have to get the greatest yield you can while taking the least amount of risk, you probably don't want to take smart contract risk on a public chain where anyone in the world can see your position. And if you're a fiduciary and you can't earn yield on Circle or Tether, then by law, like, you've basically got to migrate your capital to Canton, because you'll get sued if you don't. So
well, I got two questions. So one of them is, I know the Clarity Act, not the Genius Act, that's still being marked up. They bumped it. It was supposed to be voted on tomorrow, but they bumped it to the end of next month. That's the one that hasn't been signed into law yet, and they're talking about the stablecoin yield. And the way that it's currently worded, I know that Coinbase just announced that they're withdrawing their support of it, because they want, obviously, to be able to pay people yield for USDC, on their platform. But they were, what was it they were doing? The way that the Clarity Act was worded when I looked through it about a week ago was that in DeFi, you can earn on stables. They just can't pay yield for simply holding it. Like, if you have it on Coinbase, they can't directly pay you yield just for storing it on Coinbase. You have to lend it out or, do something like that to be able to earn yield with it. The company that's on Canton that's doing the repos is called Broadridge. Were you able to find anything on that?
That does not ring a bell, but what I can say though is I looked into the roadmap, JP Morgan's roadmap for the next 24 months, and it looks like they want to move 15% of their wholesale repo business onto digital rails. And so that is Connexus Canton. So they're going to move a ton of their flow onto these, they call them DLT rails. But what does that mean for public chains? Because if we take a look over here, this deposit token, JPMD, you see, I think a lot of this, Myke and Jake, is almost like a matter of semantics. Like you're fighting over the language that's used in these pieces of legislation. Because if you've got a public stable coin, okay, that's your USDC, but then JP Morgan launches its deposit token, which for all intents and purposes can be treated like a stable, but because it's a slightly different product, JP Morgan they can pay whatever interest on this deposit token they want. So that instantly makes it more attractive, because if JP Morgan is paying 4% on their deposit tokens, and Circle and Tether are prohibited by law from paying anything on theirs, and for you to actually get yield on your Circle or your Tether, you've got to supply it as collateral on a money market like Aave. Well, you got to take an extra layer of risk. You've got smart contract risk when you do that. So, it makes these deposit tokens look more attractive, but these are regulated products. So, I mean, they both are. But what do you think? I mean, are you going to start holding JPMD, on the base chain instead of USDC or USDT? I don't know.
Really, for me, it really just depends on, kind of the DeFi opportunities, the earning that I can do with it. Because, I mean, I know it's an unpopular opinion, with the kind of crypto punks, the kind of old school mentality of the decentralized utopia of crypto. And I'm all for that, but at the same time, you have to be realistic. It's like, are you gonna, stick to Zcash and things like that, and not be able to earn, or I mean, they're great ways to store value, but the way that the future financial system is going to be is the projects that the token is compliant and the project is compliant and the protocol is compliant, and they're going to have to do KYC. A lot of people are kicking and screaming about that, and AML and all that.
People should be kicking and screaming about that.
Absolutely.
Yeah,
I get it, but it's you can scream into the wind, it's and it's just it's one of those where we need to and I don't want to get into the get away from the topic, but we just have to elect better people in the office, and until then we got what we got. And so I'm gonna opt to make money to outpace the inflation and the wasteful spending of our tax dollars, so that I can improve my quality of life and not live in a mud hut because our government fucking sucks.
Yeah, no kidding, man. So speaking of earning yield to improve quality of life, let me share this with you guys. I think you'll both find this to be pretty interesting. So I was going through Stephen TCG's recent content. In fact, let me see if I can just pull that up. If I open this up here, let me hit refresh in Notebook LM. And here it is. So the last two pieces of content that Stephen TCG posted on YouTube, what I did is I copied those links. I threw them in here to Notebook LM, and then I asked it just a really, really simple prompt. I said, hey, I want you to pull out each and every discrete protocol mentioned and the yields on each of those protocols. And so after it did that, it gave me this long list of different protocols to take a look at. And then I opened them all up over here, different tabs. So I could start scrolling through and taking a look at the different yields that are available to me on all of these different protocols. There's like a dozen of them. But it's one thing to find all these yields. it's a whole nother thing entirely to actually build a portfolio with those products. And so that's where Cursor comes in. So what I did over here in Cursor is I built a DeFi flight simulator that allows you to take all of your prospective positions, type them in, the yield, whether you're looped or not, stuff like this. Jake, I think this is like a beta version of like kind of like what you've already built. You know, and then so like let's see here. Like I think I've got a copy of this open right here. So you know, maybe I want a USDC position, and it's going to be on Aave and the asset, you know, USDC whatever, and capital amount 10K, and maybe I'm earning 3.5%. And so I can add position, and what do you know? Bada bing, bada boom. There we go. I've got a position. So I can add a bunch of positions here. I can add looped positions, and then I can start to build a risk model for my fixed income portfolio. And I can think and project out what would happen in the event of a stablecoin depeg. So I can actually track my risk summary. And if I had a bunch of other positions in here, then you would be able to see my health factor on the right-hand side here. And it would change based on, you know, whether there's a depeg or not. So just kind of an interesting little tool that I threw together in, you know, half an hour this morning. But yeah, that's kind of, I'm really thinking about, you know, fixed income and building a fixed income portfolio, because I'm just not convinced that liquidity provision is actually structurally profitable. That's the thing. It's like, it feels like when I provide liquidity that I'm just kind of like spinning my wheels. And, you know, the fee APRs, I don't think that that's the metric that really tells you if you're profitable or not.
It's not at all.
It's not. Yeah.
We need an APR, and we'll build this into Metrix V4. So what we have on Metrix right now is something called retention. Now, retention, it works like some of the time, it doesn't. That's because you could have like negative 400% retention, and that's how you know your portfolio is not doing well. But it basically takes your impermanent loss plus your fees. So your impermanent loss is a negative number. So say it's negative 100, and then you have fees of 200. So it takes negative 100 plus 200, which equals 100, which would mean that your retention is 50%, because it takes the versus HODL number, which is 100, and it just simply divides it by how many total fees you have. And it tells you how many fees go in your pocket after impermanent loss. If you were to pay down your impermanent loss, and when I say pay down, I mean you got 100 impermanent loss in the pool, you reinvest $100 of fees into the pool to account for that, right? If you're to pay down your impermanent loss, here's exactly how much money you're left with. And that would be 50%. So 50% of your earnings go to pay down impermanent loss. What you can do with this retention number now is you can multiply it by your APR. If you have an APR of 100%, and that's your like total income that you're producing, what's your APR after you factor in the impermanent loss? Well, now it's 50%. So what this does, David and Myke, is it creates essentially a flow of, hey, this position is doing 100% APR, but I am left with an effective APR of 20% at the end of the day after all the impermanent loss. But if I take lower risk and I go for lower APR at maybe a 50% APR, but then my effective APR is 40%, that's more attractive. Lower risk, and it generates more money and puts more money in your pocket after impermanent loss. So that's one of the things that
makes a lot of sense.
So
yeah.
Again, there's
arguments to be made of asset accumulation versus like stability and stuff like that. But yeah, with asset accumulation, David, we're just looking for stuff that has low price volatility. And one of the strategies, this is a really fun one actually that I want to share real quick, basically. One of the strategies that I like to run is with ETH USDC and Bitcoin USDC, but when I adjust this, I am going to stop using Bitcoin because it's lower yield. But basically, here's what we're doing. Myke, I just shared my screen. So over here, I have Aave. I have ETH, Bitcoin, Link, Uni, Aave that I'm supplying, right? It's about $78,000. And then I'm borrowing $20,000 of Go. Now this Go, I'm splitting between a couple different strategies. But if you wanted to run just one strategy, you could take $20,000
and you can park it in something like ETH to USDC. And then when you do that, you convert half of your USDC into ETH, right? Half of the stablecoin into ETH. That creates a long on ETH. So let's look at that. And let's assume that we have -12 plus 12 range for simplicity. We have $20,000. Well, we start with 47% ETH, 53% USDC. So that means 47% of this is sold into ETH. The other 53% is sold into USDC, another stablecoin. But then when we go to simulate, what happens when we go to the top of our range? 3761. So let's just say 3,800. Now we have $20,549. We have a $549 profit compared to our borrow. We borrowed 20 grand. We now have $20,549, not to mention any fees that we generate. So what do? We close out the position. We repay the borrow. We keep the spread. That spread, as well as the yield, we go and we put it up as more collateral. And then what we do is we wait to execute at another time. Now, what happens if it goes down? Well, that's a good question. So if we go to 2,900, we now have 6.16 ETH, in which we would be holding until our initial entry price, which would be 33.57. And if we hold it to our initial entry price, we have $20,698. Why? Because on the way down, it's buying more ETH. It's giving us new ETH at a lower cost basis than the initial ETH that we bought, which brings down our actual overall cost basis. So now at our break-even price, we have a profit of $698 plus yield. And then what do? We repay the borrow. We keep the spread as well as the yield, and we put that as collateral, and then we execute at a better time. So that's one of the strategies that I've been putting a lot of people on, and a lot of our.
So Jake, I kind of got lost there. So I got lost on the way down.
Okay, yeah.
So yeah, can you? I can barely see this. So you borrow 20K in Go, and you take that 20K, you enter an LP, so you're swapping half of it for ETH. I just want to make sure that I got this right. Yes. Okay, so you swap half of it for ETH, and then what you're saying is on the way down, I want to understand, how do you get to profitability in US dollar terms on the way down?
You wait. You wait. That's the fun part. So again, on an asset accumulation side, what we're doing is on the way down, in the instance where we end up in all ETH, right? And this is, once again, going to be better in a bull market. And maybe we're doing a retracement, and that's why we're on the way down. But you hold that ETH, and then you don't put it back in a liquidity pool. You don't wait for the liquidity pool to go back in range. You exit, you hold the ETH. So now you're holding full ETH, right? And your USDC was used to buy that ETH on the way down. So then by holding that to the entry price, right, the price that you executed the borrow at, you have a profit because you lowered that cost basis on the way down, basically. So you have to hold it until your initial entry. But the beauty of it is, if it takes a while to get there, you can take that ETH and you can put it back as collateral on Aave in the meantime, and make sure that you're staking it. So that way you can kind of offset some of your borrow costs that you're waiting on, and you still have a little bit of leverage.
I think I get it. You're talking about just as it goes down, you're getting more ETH, then you exit the position so that you're locking in that amount of ETH, and then you're saying you have to wait until it goes back up to your entry price, and then that's how you're getting the $700.
Right. So basically, what you're doing is,
and also all the yield,
yeah. So on the way down, you're profitable in ETH terms.
Correct.
But you've got a bunch of divergence. And so when you remove your capital from the pool, you realize that divergence.
Correct.
And so you take that ETH, you throw it on Aave, and then, hey, you know what? If ETH returns to your entry, you would, do a little bit better than break even. You'd have a profit on that for sure.
And then you'd also have the yield. Yeah. So my theory on this is an accumulation strategy. It's a way to basically print a couple percentage points in ETH, basically. In other words, for example, on our borrow, right, on the way up, we're just simply selling the ETH on the way up. We make a little bit of money there. And then we take that spread, we increase our collateral. On the way down, we obviously dollar cost average into ETH, which we can then go hold on Aave. And then once back at our entry, we go and we repay the borrow and execute at a better price. And we're just slowly printing more ETH, and we're accumulating more of the actual asset. But again, it's relying on market circumstances. And it's important to have a strategy for both ways. So I've been doing this.
It's
And
important
luckily,
to have a strategy when you swing both ways.
I would say so, yeah. But again, I'm running this strategy. I have a $20,000 borrow. Now with me, I have 6,000 that I put into USDC to ETH and 6,000 in USDC to wrap Bitcoin. Of that, 5,000 on each of these was from the borrow. The 1,000 was from my wallet on each of these, the additional $1,000, because the other 10 grand is split between ETH USDC and wrap Bitcoin USDC on GMX. Full range pools, I put 5 grand there. But the performance, since the market's chopped, it's gone up and down. And I have a range on Bitcoin of 80 to 108. It's a broad range. On ETH,
That's actually the same range that I got. So yeah,
2,600 to 3,900 on ETH. And that's why I'm liking the ETH one better. It's better yield. Again, numbers, I'm keeping the majority of my money. But like, look at this. I've already generated basically $290 in overall profit on wrap Bitcoin to USDC, $425 on ETH, and I'm profitable on both versus HODL metrics over here as well. And that's just,
what's the time frame, Jake? I'm sorry for interrupting you. How long have you been holding these positions open for?
Since December 4th. So a little over a month.
Got it.
Yeah. And they've chopped up, down, sideways, right? So they've done their job basically. Again, execute with broader ranges. You're not necessarily worried about trading these. You're not over trading. You're doing it where you're playing the market in a phase, basically. Like right now, the market's in a phase. I'm just playing that phase. So
let's say that Bitcoin and ETH move to the top of your ranges. And let's say that they do that like over the next 24 hours, like quickly.
Yeah.
What would your divergence look like at the top of your ranges? Would you still be profitable compared to holding?
Probably not. But
Right.
frankly, it doesn't matter because I borrowed against my Bitcoin and my Ethereum, right? And that's what I care about, having market exposure. This is what has my full upside, basically, right? But my point is, when I say it doesn't matter, I mean it doesn't matter in the sense where I'm going to go and pay back this borrow. If I'm going to go and execute another pool right after that, that impermanent loss does matter, even though it is borrowed capital. But in the sense where I'm like, hey, I'm repaying this. This strategy is done. I will execute another strategy in a couple days, maybe a week or two, right? And that will be completely separate. That's where it doesn't matter, basically, because we're separating it, basically.
Yeah, Jake, the way that I like to think about this, though, is I like to compare it to if I had done nothing at all.
Mhm.
So if I've got, an asset on Aave, I borrow against it, and I want to enter an LP, and then I go out of range on the upside, if I'm going to be underperforming, having done nothing at all, meaning you take the borrow and go, and then, the go token, you swap it all for ETH or you swap it all for Bitcoin, and then you do nothing.
Yeah.
If the LP is going to underperform doing nothing, then it's kind of like, it's like a fugazi.
No, of course.
It's no matter. It is not real. It's almost like you become the yield because your gamma, that's your impermanent loss. That's your volatility there. You're always short volatility as an LP. If your theta, those are your fees. If your fees are not greater than your impermanent loss, your gamma, then you're not profitable. And so I'm just thinking to myself, like, well, would it be easier just to do nothing? And I don't know. That's a question for the individual investor, right?
Of course. So the do nothing approach in this case would just be letting the ETH and the Bitcoin collateral ride up, do whatever they want, and not borrowing and not putting that anywhere, basically, right? And then the doing something approach adds to this collateral over time. And then, of course, like, so with your example, say we go to the top of the range, we might not be profitable on versus HODL, which in this case, I think I'm going to be because I have 163 of earnings. And then this would have 140 of loss to impermanent loss, right? So I'd be profitable there. That's only because I've been in the position for a month and a half, But in this situation where I wasn't, I would still have a $260 profit compared to what I borrowed. And that $260 profit is what I can then go and inject back in as actual collateral, repay the borrow, basically.
Sure.
So again, there's an argument to be made, though, David. What if instead of borrowing, put in the LP, earning the yield, whatever, you just took that borrow and you stuck it in Bitcoin and then you held the Bitcoin up, obviously you'd have more money because you don't have the use.
Right. But
then you have a leveraged Bitcoin position as opposed to having a semi-leveraged Bitcoin position that generates you yield over time. Like the way I like to think about these things is with liquidity pools, you have that trade-off, which is that impermanent loss.
Right.
But the thing is, the trade-off is instead of speculating so much on the long term, you're generating some of that income in the short term. And that will cost you a little bit of money in the long term. But if it means that you are collecting more in the short term, that is more predictable than speculating on where an asset's going to be in a year, that is a trade-off that I would be willing to make to an extent that also some other people would be willing to make. But then other people would be like, nah, I'm holding for 10 years. I'm going to go stick Bitcoin in my Roth IRA and I'm not going to do shit. Like that's an argument you made as well. It depends on the investor though and the profile. So,
oh, for sure. It definitely does. Now, let me ask you this.
Yeah.
What do you do on the way down? Like, let's say that, you know, the investment thesis is wrong. And instead of appreciating to 126 and fresh all-time highs, Bitcoin moves to 75K. How do you protect the downside?
That's actually a good question for right now. You know, everyone's starting to get kind of bullish again. They're thinking we're going to go back up, but yeah, what happens if it, you know, it goes back on you?
Yeah, 100%. So my liquidation threshold is 78%, which means when my borrow is 78% of my supply, that's where I'll be liquidated. So in my situation, basically, I would have to have my collateral go down from $78,000 to $25,000. So from 78 to 25, which means in order for me to be liquidated, the market would have to go down that 67% basically, which is not something that I foresee happening anytime soon. But it also gives me time to go and repay borrows if I do need to, because it's not going to happen overnight.
And that's key. You know, I mean, is making sure that you have that liquidity on the side that you can pay those down in case of an emergency, so you don't get liquidated.
Yeah, well, Mike, I know if the market's going down 67%, I'm buying. Like, and when I buy, I can go and inject more collateral, and then that solves the problem.
That's another direction you could go as well.
Repay a borrow, you can inject more collateral. One of the things I like to think about is like, how can we lower the risk?
As long as it stays healthy, yeah.
Yeah. How can we use the risk, or sorry, how can we use the yield to lower the risk over time? So one of the things I do with my flywheel is I take income and I increase collateral. You see, a lot of people are quick to say, oh, I take income and I repay borrow. But if the market's going up, why would you want to repay the borrow? You wouldn't, because you're just selling your income to repay a borrow, but the market's going up. So you're getting further and further away from liquidation in the instance where the market's going up. So why not increase collateral where you have more market exposure? So you're still getting further and further away, not as fast of a pace as if you were to just repay borrow, but at the same time, it doesn't really matter because the market's going up anyways. The only reason why you want to repay borrow is if you are in a downwards market and you want to start lowering your risk and you expect the market to continue to move down, because then you wouldn't want to increase collateral because you're going to buy an asset that's going to go down. You'd want to repay borrow instead. So again, there's different times to do different things.
So Jake, you know what would be really, really cool, man, is if in Metrix, in some future iteration of Metrix, is if you could calculate the implied volatility in the pool. Because if you can calculate that, you can compare it to the realized volatility external to the pool. You see, the challenge for me, Jake, you know, after having done this like professionally for quite a while, is I'm just not convinced that liquidity provision is actually structurally profitable in V3. I'm just not. I think that most, if not all, pools are probably structurally unprofitable, meaning your theta, your fees, is almost never going to be greater than your gamma, your implied impermanent loss. So I have a really hard time. Look, I've still got a pool open. I've got 50K in an ETH USDC pool, and here I can share with you what that looks like if you want to see it. But it's not profitable compared to holding.
Yeah.
And it's been open for over a month. I haven't rebalanced, but it's almost like the fees that you earn it's like you're spinning your wheels. It's almost like you become the yield against yourself and you never actually get anywhere. And then if the market rips higher, well, you almost always underperform holding. If the market dumps and you have no hedge, you're not going to be very happy about that.
Yeah.
So yeah, like the thing that we need, Jake, is we need a window into variance risk premium. You see, when we provide liquidity, we're short options.
Yeah.
And the only time it makes sense to be short options is when implied vol is greater than realized vol. Structurally speaking, if that is not the case, it's not profitable to be an LP. So like I'm stepping away from, the full-time LP game because, dude, it's just like, it just is not profitable. And like what you really need is you need a V4 hook where you've got MEV protection, where you've got lever protection through the use of oracles, where you've got a variable fee tier that also helps protect against lever. If you had all of those things together, well, then at least you would remove all of the structural problems where arbitrage bots can exploit you as an LP. But then you got to ask yourself, well, where does the majority of the volume in these pools come from? I think the majority of the volume probably comes from like Wintermute. Like one of these big market makers on Binance, they've got like 1 millisecond feeds. So they can see the price in these Uniswap pools instantaneously. Yeah. And they can just, buy when the price is depressed in the pool and sell it on Binance and capture that spread instantaneously.
Yeah.
So if that inefficiency was solved for, I don't know that they would like actually continue to arb that. They wouldn't be able to. So the volumes would
I know that's the new Aerodrome platform. I know that the MEV, what is it they called it? Oh, sorry, I'm drawing a blank. But they actually announced
Slipstream.
Yeah, and they have some other engines and stuff like that, and MEV, to combat that MEV issue that you're talking about.
Yeah, it's a couple of things. So it's MEV, it's loss versus rebalancing. It's, you need a variable fee tier on the pool. You need oracles attached to the pool. If you do all four of those things, well, okay, great. Now you've, removed all of those exploitable structural problems.
Gotcha.
But you haven't fixed the fact that when you provide liquidity, the implied vol must be greater than the realized vol. Otherwise, there's no reason to provide liquidity. So the way that happens is with massive volumes. Like you need a ton of volume. Mm-hmm. So in the absence of a ton of volume, I don't think it makes sense.
David, what I was going to say is, obviously we all know this, but like the most profitable time to provide liquidity is when the market's going sideways, because it's going to, despite going sideways, it's going to jump up maybe 1% to down 1% to
for ranged pools. Absolutely.
Yeah. So you almost need like, and again, this can be done pretty easily. You almost need a trading view indicator or something like that literally shows a period of when you should provide liquidity and when you shouldn't. And then from there
is one. It's called the Hurst exponent.
The Hurst exponent.
Yeah. So the Hurst exponent is going to measure trending versus range bound or mean reverting assets. Okay.
I'll have to look at it. But yeah, I mean, that's exactly what you need, because if you only provide liquidity while the market's consolidating, you close your pool before the consolidation, obviously, period turns into like a market pump or dump, like, you're good. And then you hold or you be in stables or something like that. But yeah, I mean, one of the things I'm liking right now is like trying other stuff. Like I'm holding my accumulation portfolio, don't get me wrong, and that's the majority of my portfolio. And I'm liking the recent market gains, and pools have been doing good because it's been like a slow move up. It hasn't been like plus 10% in one day or 20% in one day for any of the assets I'm holding. But at the same time, I'm liking exploring. Like, so I have like 40 grand or so, 50 grand or 40 grand that I'm trying in like stablecoin plus like hedged LPs. Those are doing well. And then I also have like 8 grand that I'm running with like a bot that automatically hedges my LPs. And then I'm playing around with some more money, and I'll play around with some money on this Hurst indicator.
Yeah.
To see
so Jake, one thing that I've learned about hedging the LPs is that even when you're under hedged, the hedge itself kind of sort of forces you to realize divergence, especially on the way up. And that sucks, you
Yeah,
know?
it does.
Yeah.
Hey,
Yeah.
one of the guys in the chat on Arena says, "Can you write the name of that indicator so I can look at the logic in its code?" I guess
Sure.
he's gonna see if he can actually do an indicator, like write a code for the indicator for TradingView.
Yeah. So it's called Hearst, like William Randolph Hearst.
HURST.
Yeah, HURST.
All right, cool. Yeah, that's what I typed. Well, real quick, we have about 10 minutes left. I kind of wanted to get your guys' input, back to Canton. I noticed this today. You can see that the daily burn activity is, starting to spike. And then the mint, you can barely see it. It's here at the end. It's actually starting to roll over. And the amount of tokens being minted is going way down. So currently we're just shy of a 0.5. So for every 2 tokens that are minted, 1 is burned. With the network usage, as the network usage goes up, eventually we reach a point that they call equilibrium, to where the amount of burn matches the amount of mint. And then of course, if the network keeps going up as far as being used, network activity, then the burn will actually outpace the mint and it will become deflationary. And you can kind of see this happening here at the bottom, this purple line. This is the burn mint ratio. Here, I'll actually zoom in a little bit so you can see it a little better. But you can see that, recently, right now, Canton is earning $1.7 million per day in fees from network usage. That is being burned. So, that's kind of, what's going on with the tokenomics. But yeah.
And Myke, if you take a look at the chart, it's a phenomenally good looking, cup with handle pattern.
Oh, yeah.
Yeah.
I'm actually interviewing, and I don't know if you had the time, maybe David, it might be good to have you on the show. I'm going to be interviewing the COO of Canton Network this coming Tuesday. His name's Shaw, and he actually was one of the original people that built out Zcash. And then
sounds great, man.
Yeah, and now he's the COO of Canton Network and one of the co-founders, and he agreed to come on the show. He was former military as well, and said he'd come on the show, and we're just going to ask him all the probing questions. And I mean, it would probably be really good to have you, because you could ask some very pointed questions, very technical questions.
Hell yeah, man. I'd love to. And,
right.
Also, I saw in the chat that there were a couple of guys asking about more content on Canton. So Myke, I actually put together a video all about Canton and that siphon effect. It might be interesting to play. I don't know if...
Yeah, no, go ahead. I mean,
Yeah,
as long as it's not longer than 7 minutes.
No. It should be 5 minutes. So here, let me see. Let me see if I can play audio through this. I don't know if it's going to work, Myke. We'll see, I guess. So I'm going to hop on into the Canton one, institutional. There it is, Connexus Canton. And let's just take a look. Now, Myke, let me know if you guys can hear this or not.
All right.
No, you can't hear it? Okay. Yeah, so it's probably not.
Usually when you share your screen, there's a little toggle to share the audio as well.
You have to share the actual tab. So if you're on Chrome or some type of Chromium browser, you have to share the tab.
Gotcha. Okay. So here, let me stop the screen share. I'm going to start a new screen share. And it says actually present video file, but I don't have this downloaded, I don't think. So all I got to do then, I guess, is download the video file, and then I should just be able to share that, right? So let me just.
Well, we could also do it tomorrow. I mean, if you're gonna be at the Crypto and Chill or not Crypto and Chill, but our little conspiracy show that we're gonna start doing every Thursday.
Oh hell yeah, man! I like conspiracies. I gotta get my tinfoil hat out. But
that last one got spicy, man.
Oh hell yeah, man! So you see, Myke, I added it here.
For years, the whole story was crypto.
Is that working?
Yep, I could hear it.
Versus Wall Street, but that's not the story anymore. Right now, giants like JP Morgan, they aren't just interested in crypto, they're actively building their own version of it. What we're seeing is this massive collision between traditional finance and the crypto world, and it is creating a wild, unpredictable new landscape. So that brings us to the big question, right? What is their actual endgame here? Are these huge institutions building a bridge that's going to bring trillions of dollars into public crypto? Or are they acting more like a vampire, creating a parallel system that's designed to slowly drain the life out of public chains? The truth is, there's a really compelling case to be made for both. And really, what this all boils down to is two totally different visions for the future. The original crypto dream, that was all about open, public blockchains that anyone could access. But this new institutional reality, it's all about closed, permission, and private networks. Wall Street needs control, they need compliance, they need privacy. And let's be honest, public chains like Ethereum just aren't built for that. And this fundamental clash is setting the stage for everything that comes next. Okay, so let's dig into that vampire argument first. The analysis calls this the siphon effect. This is the theory that these new institutional networks are basically engineered to systematically pull value away from public crypto. And it all kicks off with one single incredibly important piece of law. And this is it, the Genius Act. Now, it was supposedly designed to make stablecoins legitimate. But what it really did was create a massive built-in advantage for the big commercial banks. It completely rewrote the rule book for digital money in the US, and in doing so, it opened up a huge arbitrage opportunity. See, here's the clever part, or the scary part, depending on how you look at it. The law drew a line in the sand. It flat out bans public stablecoins like USDC from offering any kind of interest or yield, but it created a special carve-out for something called deposit tokens, which are basically just digital bank deposits. And since JPM coin is legally a bank deposit, JP Morgan can pay interest on it. This isn't just a minor detail. It changes the entire game. And boom, this chart right here shows you exactly what that does. A JP Morgan deposit token can earn, say, 4%. Meanwhile, a public stablecoin like USDC is legally required to earn 0. So if you're managing a company's treasury or a big investment fund, you have a duty to get the best return. The choice isn't just easy, it's practically mandatory. And if you want to put a dollar figure on that, imagine a fund with $1 billion in cash. By keeping that money in a public stablecoin, they are literally leaving $40 million on the table every single year. That's not just an opportunity cost, that's the kind of thing that gets you fired. This is the raw economic power behind the siphon effect. But wait, it gets even crazier. It's not just about cash being siphoned away. There's another huge force at work here, something the analysis calls the collateral vacuum. And this is all about where the really valuable assets, like tokenized US treasuries, are going to end up living. So why? Well, it all comes down to privacy. Think about the repo market. It's this $4 trillion a month beast that runs the entire financial system, and it relies on total discretion. If you're a hedge fund and you make a trade on a public chain, everyone can see it. Your whole strategy is out in the open. But these private networks like Canton, they're built with what's called sub-transaction privacy, so only the people in the deal can see the details. For big money finance, that's not a nice to have, it's an absolute must. All right, so that's the vampire case. And honestly, it sounds pretty bad for public crypto, right? But here's the twist. What if I told you the very same institutions that are siphoning value away with one hand are actually injecting new life into public chains with the other? This is the bridge argument. So check this out, JP Morgan has actually put its JPM coin, the same exact yield-bearing token, directly onto Base, which is a public layer 2 built on top of Ethereum. Now, why would they do that? Well, because high-value trading needs that fortress of privacy, but the world of everyday payments, that needs speed and open access. So by putting JPM coin on Base, they're bringing legitimate bank-grade volume directly into the public crypto ecosystem. Yeah, this quote from the source material just nails it. The siphon is draining those big, slow pools of capital from Ethereum itself. But at the exact same time, the bridge is flooding these faster, cheaper layer 2s like Base with a tidal wave of new transactions.
So, but ask yourself this question, what does that mean for ETH? Does this, if there is a significant increase in volumes on Base, what does that mean for Ethereum? For the price of Ethereum, does that mean number go up? Like, what's the connection between volume on the chain and price of the coin? And so I actually put together a model, taking a look at what's that network effect called again? I can't even remember the guy's name. He's some mathematician, but the network effect, it's a law, Metcalfe's law. So
Yeah.
I put together a model. I used Metcalfe's law to model out, based on daily active addresses, the price of Ethereum. And we need more users. We need massive user growth across all the Ethereum chains for ETH to really start to rally. But you guys, if we get massive user growth, then I mean, those numbers of like $150,000 ETH, that actually comes into play. That might sound crazy, right? But if the number of daily active addresses on the chain actually accrue value to the chain, and that number of daily active addresses, that number of users goes up exponentially, dude, then you could definitely see ETH above 100K for sure.
I think it can happen, with everything that's being built out on, the layer twos on ETH and, ETH and, I mean, JP Morgan, they put their, new coin on Ethereum as well. So, I mean, there's a lot of, usage of the network and the fees that are going to be generated, as a result.
Yeah, no kidding, man. So, hey, do you guys want to play the rest of this, or there's I think 3 minutes left?
I mean, if you need a dip, Jake, I mean, we can go ahead and just finish playing it and then cut off the show after that.
No, I got a couple minutes.
All right,
Awesome.
cool. Go
It's
ahead.
not one or the other. It's both, happening at the same time. Okay, so where does that leave us? It means the whole bridge versus vampire debate is kind of the wrong way to look at it. It's not one big fight for a single system. What we're actually watching is the birth of a permanent two-tiered financial world. It's like a tale of two internets, but for money. Let's break down what this new world actually looks like. You've got Tier 1, the institutional fortress. Think networks like Canton. This is private, it's regulated, and it's built to move huge amounts of money slowly and safely. Then you've got Tier 2, the retail superhighway. This runs on public networks like Base and Ethereum. It's all about speed, handling millions of smaller, everyday transactions. They're two different worlds, but they are connected. And look, this split isn't just some abstract idea. It has huge, real-world consequences. It's creating a brand new set of winners and losers. And if you understand this split, you can start to see where the value is going to flow next. So let's look at who's set up for success and who might be in trouble. So first up, who's in trouble here? Well, some of the original, foundational blue chips of the old DeFi world are facing some pretty serious headwinds.
Yeah,
Basically,
DAI.
any protocol
DAI's in
that bet
trouble.
the farm on one single open financial internet, well, they're starting to look a little shaky. Take MakerDAO. Its stablecoin DAI can't offer yield, which makes it totally uncompetitive for institutional money against something like JPM Coin. And Uniswap, the king of public decentralized exchanges, simply can't handle institutional trading because it doesn't have the privacy or the compliance tools they need. Their core businesses are being siphoned off. But hey, it's not all doom and gloom. Where some protocols are at risk, others are perfectly positioned for this new reality. A new class of protocols is rising, and their whole purpose is not to compete with these two worlds, but to connect them.
Aerodrome's
The real
one of 'em.
winners, they're the ones who aren't picking a side. They're the connectors, the diplomats, the plumbers of this new system. You have Aave with its permissioned protocol called Horizon, which is basically becoming the regulated bridge where institutional money from Canton can meet public assets on Base. And then you have Chainlink, whose CCIP technology is literally the secure plumbing that lets value flow between these two separate internets. Their whole job is to service this new divided world. So that's where we land. The future of finance isn't one giant global network. It's a split system. On one side, you have an institutional fortress built for preserving wealth. On the other, a public superhighway built for commerce and innovation. We have two internets of money. And the question this really leaves us with is, which one are you going to use?
Right, but the big problem for me with a token like Link or Aave, but especially Link, is it's kind of unclear. Like, how much money does Chainlink actually make? Like, as a business,
I don't think they made a
Chainlink-
lot.
I don't think they make anything at all.
Yeah.
Well,
You know?
and that's a good question because
Like, how much money do they spend, David? That's more like, it's not
Bro,
like they could have zero revenue. They could have 150 million in revenue, but if they're spending more than, like, that's where we have to worry. So
Jake, the
Well,
last time I looked at
question mark right now with a lot of these crypto projects is, before, it was pure speculation. People were just buying the token and hoping the price, it got hyped on social media, or Elon, tweeted a picture of a Shiba Inu so that Doge would go up. That's the old crypto is just, trying to chase narratives.
I think
Whereas
that's dying,
that's exactly what I'm getting at is I think that is dying, and we're starting to move to a more institutional and smart money mindset. And it's kind of why I'm excited about this interview is I really want to ask Shaw and, his opinion on, what is the, kind of benefit of holding the Canton token, the CC token. I know that I'm, earning with it right now. I found a way to earn with it, but long term, how is that, currently $1.7 million a day that they're earning in fees that they burn, the tokens that they burn, how is that value? And I got this from you, David, it's the question I'm always asking myself now. How is that profit or that revenue being shared with the token holders?
Right.
Because that's what we need to ask ourselves about these projects. It's not just community. It's not just like, oh, there's a great community out there and we all, hype each other up and we talk and we chat and, that's great. But I don't think that is what is going to make tokens go up. There's always going to be meme coins, but I think these, legitimate projects or, legitimate projects that are supposed to be addressing pain points. We really need to start looking at them using a different checklist than we used to.
Yeah, 100%. A lot of the things are going to get washed out, and we're going to have a lot of new cool stuff on the market is my theory. But regarding Link, somebody said Link makes big money. The thing is, it's hard to track, like, especially with stuff like Link, like how much money is actually being made without their input. Because again, you can track the on-chain stuff, but like off-chain revenue, they have big players and they have like people they're going to pay with like credit card and whatnot. People they're going to pay with wire transfer, and that's something that we can't track. So like, I'm looking at what's that?
Dirty fiat.
Yeah, exactly. I'm looking at the 90-day sum. It shows they made 14 million in the last 90 days, which is like good. Don't get me wrong, because if you do that, you're making like what?
60.
Yeah.
Yeah, but let's say they're making $60 million a year. How much are they spending?
$16 billion market cap, though. By the way, like, so like,
how does that make sense? Make that make sense, right?
That's what I'm getting at. Is I mean, I know that a lot of channels out there, and this is why I don't do price predictions. You'll never see me do price predictions because we don't know. We're in price. Price discovery could get ugly. Price discovery doesn't just mean price go up. It means, some of these tokens that we hold, they could be worth a couple of cents a piece or something, depending on the project and the revenue and how it's valuated, how that company is valuated, and then how that valuation, translates to the token price. There's a lot of question marks out there that we need to ask ourselves.
100%.
I mean, so Jake, what you just said though about Chainlink, $13 billion market cap, supported by 60 million ARR. Like, dude, how do you square that? Like,
that's on-chain revenue, but even if you have like off-chain, like it's still like, yeah.
Let's see.
And not to mention spend. Don't get me wrong, spend is a big factor. So yeah.
So I mean, look, it's incredibly useful. Like Chainlink is incredibly useful.
Yeah.
But if they're making $60 million a year, just from what you can see, let's say that it's double that.
And that's just currently. It can scale, but yeah, keep going.
Yeah, let's just say it's double that though. How does that accrue to holders of Link? Like if you hold Link, why does it matter how much they're making? The reason why it matters is because if none of those revenues return to you in any way, shape, or form, then you're kind of sort of holding a meme coin with
you're holding a baseball card.
Like with a $13 billion market cap. Like, why would you do that?
Literally, you're holding a baseball card. I used that analogy the other day because the sports, the athlete, they're making a bunch of money and they're, they got, their sponsorships and all that stuff. And you're holding a representation of that athlete, but it's not like he pays you for holding his baseball card or his football card. You just have like, hey, I'm a fan. I'm a fan of your project. Here's my tokens that I bought of yours. That's really all it is. So
Yeah, man. I don't know. It seems like a straight up gamble. And then when you actually dig into it, like why is it worth 13 billion? Like why 13 billion? Why not 1.3 billion or 500 million? Like why 13 billion? It just doesn't seem like that's supported by the protocol revenues at all.
well, and isn't the valuation of and I know it's more complex, but basically it's like you take the annual revenue and you multiply it by 5, and that's the valuation.
No, so the market cap is the float, the number of
No,
tokens.
not the market cap, but like a business valuation. So like if you were going to evaluate a company, you would look at, a bunch of factors, and then, basically you come up with a number, and then it's over a 5-year period or something like that.
Yeah, you're talking about some type of a multiple. So
Yeah.
what type of multiple do you want to apply to those cash flows?
Yeah.
Like 150x? Like, come on.
No. Usually for a business, and this isn't something I'm an expert in, but I do believe it's your annual revenue times 5. Like if you're selling a company.
But SaaS this is going to be different at all stages. Like, so if I start a company like tomorrow and then I raise capital in a couple months, I'm pre-revenue, which is great. If I start a company and I spend a bunch of that money and then I go raise again, that's also great. Like, because again, I'm unprofitable. But the second I make like say 100 grand and somebody wants to value me at like 5x EBITDA, it's like I can only raise it at 500 grand instead of raising at 5 mil now. So it's like you always want to be unprofitable as a company if you're trying to raise money, because again, they're going to value higher based on your potential. Whereas once you have revenue, they start to value at lower numbers based on your actual revenue and profit. So,
yeah.
Hell yeah, man. Couldn't have said it better myself, Jake. That was awesome, dude.
Yeah.
Well, I definitely, we'll have to, continue this discussion tomorrow. Sprinkle in some, maybe I'll go to town and get me some liquor, and we'll have to sprinkle in some conspiracies and stuff like that. But you're more than welcome to join us, Jake. Thursdays, I'm gonna start doing a free flow. I'm sure.
Bro, like we don't have to sprinkle in conspiracies. All we've got to do is play testimony from the Supreme Court. Like, these people can't define what a boy is or a man is or a woman is. And dude, that's at the Supreme Court. Like, what the fuck is going on, man?
It's crazy.
Well,
let's see. What do we got here? If Jake starts a company, I hope they are hiring. He has a company, and he's hiring often.
They're hiring often. Yeah. Go to luminaryassets.com. You can, we have a job section. So.
But, well, gentlemen, as always, I appreciate it. It's always a great time, and I always learn something new. So, any closing thoughts?
Fun. Oh, you know what? I'm just really looking forward to seeing Bitcoin get above 100K. Like, dude, we get above that 100K level, and then I'm looking at 107 and 116. But hey, you know what? It could be a false breakout. Who knows? But I would really like to see Bitcoin and Ethereum start to rally. Look, we've seen the S&P, the NASDAQ, the Russell, gold, silver, platinum, copper, palladium, all of these assets just rip. And then I'm stuck holding my little ETH like, oh man, So I would love to see these digital assets start to, perform decently well, because it's been like holding a bag of dog shit for the last year and a half, man. So yeah, I want the rally to continue.
Oh yeah.
Well, I know I love looking at all the silver I got in my safe. So that I bought at $5 and $12. But Jake, any closing thoughts?
No, just continuing doing what I'm doing, and I'm excited to share what we're building. So,
all right. Oh, Jake, if you could stick around, I want to show you some input. One of our mods in our Discord. You should actually join our Discord so you can get input from everybody that's using Metrix and stuff. But
yeah,
I'll show you a little bit of info that he sent me.
Awesome. Yeah, we'll do.
All righty. Well, till next time, hope to see you tomorrow. It'll be 5 p.m. Pacific time, so 8 p.m. Eastern. So till next time, Veteran Crypto out.